Hey everybody, this is Osprey Eye from mychartcoach.com, and in this video we're going to take a look at the small caps that were in play on Friday. 3D systems here, ticker symbol DDD, had a really good day, closed up 10% on Friday after up every single day last week. You could see here it's really pushing hard, made the big gap up open here on Wednesday of last week, and the candles have just been riding EMA4 support higher. It did push well above that upper Bollinger Band, so if the candles do push back into the band, you want to see that EMA4 at 1776 hold. If you look here at the DDD weekly chart, you can see here that it has a hard time staying above 70 on RSI. It signaled past tops. You know, it did stay above for a couple weeks there back here in 2017. So we'll have to see if it can stay above that level. If it drops below 70 on RSI, that'll be a signal that the chart is cooling down. Keep in mind this is a weekly chart. Fasto is hitting peak levels on the weekly chart as well. You can see here this is the level that it topped out at previous runs, and it's above previous rallies as well, closing at 98.83. That signals the run is super frothy. Okay, if you look here at the plus DI, you can see here it broke out above those levels from 2017 on this big run back in May of 2017, and so it's getting very parabolic here. This will be an unsustainable move. At some point it's gonna have to cool down. If you look here, it's hitting this what is this, May to June, basically May to July resistance level. Okay, so of 2017, I guess it is May to June. These 8 candles right here are the next resistance level to break, and I'm calling it the $20 is the first level to break, and then 22 is the second. If it stalls out in this zone, you could see it take a breather next week. Now, if it busts above 22, you've got 25 up here as the 400-week moving average, and above that is the 300-week moving average up at $28. If it does pull back, failing to break that $20 resistance level, what you want to see is it stay above this 200-week moving average down here at 1637. That will be the key level to stay above. As you can see here, this uptrending channel, very strong uptrend on the weekly chart, it busted out above that top of the channel. So you just want to see it turn that level into support if you are a bull. Okay, let's look at ticker symbol MDLY, closed up 52%. This is one of the big winners last week. It had a giant gap up open. It did trade above the gap. There's a huge gap in the chart between high of day on this candle and low of day on Friday's candle, and what it needs to do is stay above the red and blue lines. If it could stay above the 300-day simple moving average at 530, that should signal that it wants to push higher. And then the next key level to break is going to be the 400-week moving average at 574. That is lined up with resistance over here back in March, and so it's going to need to break above those levels to head higher. So yeah, so keep an eye on MDLY here. If it gets above 574, the $6 to $6.20 level is going to be the next key resistance zone to break. If it dropped below 519, that's going to signal downside risk. You could see the candles work their way back into the bands. This candle is floating above the upper Bollinger Band, and what you'd want to see on a pullback is this 100-day simple moving average hold at 448. Okay, that's the big level to hold to the downside, and EMA4 at 426. Okay, take a look at AWX. All right, so yeah, this had a big move on Friday. It did close up 45%, but it was up much higher earlier in the day. You have RSI now back above 50. Fasto is still oversold down here at 11.7. That was a really ugly candle on Friday. It ran up here above 650 and it pulled back. You can see this long upper wick, and then the black real candle body. The open was the top of this candle, and so it closed below the open. Even though it was up on the day, this signals the bears were in control, except for the little bounce at the close. Okay, so what's going on now? There's a gap between high of day on Thursday and low of day on Friday. A drop down here to the top of this candle would fill the gap down here, right around that 350 level. What really needs to happen, it has to stay above the middle Bollinger Band at 369 to keep the uptrend going. If it dropped below 369, that would signal downside risk. Okay, so it needs to stay above this white candle here. You have the 550 resistance, 550 to $6 resistance zone is the next level to break. If it can break above 60, that's when you could see it get going, or above $6, that's when you could see it get going and run up to 10. Now, if you look here at the AWX weekly chart, you could see where the resistance that it's hitting back here in 2014, the March high close, the February March high close right here. It hit that resistance level level again this week and pulled back. And so that breaking above this level and pulling back, that was a sell signal. So keep an eye on it. It's going to have to stay above, I would say 575. It's in between 550 and 6. That's the top of this 2014 resistance level. It needs to get above that level and turn it into support. Anytime it gets above 575 and hits to 6, if it drops back below 575, that would be a sell signal. The last 2 weeks, dropping below that level signal downside risk. It's going to have to turn that in to support to run up to 10. Right now, the big level to break is going to be EMA 4 at 448. Okay, so you want to see it get back above EMA 4 on the weekly chart and start riding that level higher. If it turned into resistance, it would signal downside risk. It did close above EMA 8. That's the line at 396. So you want to see it stay above $4. If it dropped below 4, it could come down here to the 300-day simple or 300-week moving average at 312 to test support. Okay, take a look at AWX on the 15-minute chart. You can see the big move early in the day, and then it had the climax spike. When you have the big volume followed by the red candle above the upper Bollinger Band, the candles work their way back into the bands. Okay, so now you have a sideways channel. So you can see the very tight sideways channel here into the close. It needs to break above this high close at 215 and 230. If it can get above 450, and break up above 460 there, that's going to be your signal. Okay, yeah, it's back in play. It's above 450. It's hitting 460. It's going to run up to $5. If it struggles with 450 and it drops below $4, that's this 400 simple moving average. That's going to signal downside risk. You could see it come down here to test the 50 simple moving average at 381. Okay, take a look at RSLS, closed up 32%. It's still very oversold on RSI at 11, very oversold at FASTO at 3. This is another one of those long upper wick candle type deals. What happened is there was a gap between low of day on the 7th and high of day on the 8th. On Friday, that gap filled. You can see the upper wick here. It came up to EMA 8 here and pulled back below. When it dropped below the top of the gap at 30 cents, that was your signal to lock in gains. And if you didn't lock in gains there, look at the downside risk. It closed all the way down at 9. Anytime you break above a top of a gap after a gap fills, it has to stay above that level. If it breaks below, that's the sell signal. Now it closed back below EMA 4, so that does signal more downside risk. It has to break above EMA 4 at 17 to get the reversal going. Fail to break that level, and you could see it continue pulling back. It needs to hold the close here on the 8th. Okay, there is 2 gaps in the chart. This gap filled. There's also a gap here between the 1st and 2nd of August, and so up here right around EMA 13 is the bottom of the 2nd gap. Okay, take a look at RSLS on the 15-minute chart. You can see it started off slow on Friday, and then boom, it had the big run. It hit the 200 simple moving average, the red line, and pulled back, trading above that level and dropping back below. That was a signal to lock in gains. Anytime you break a moving average, a major moving average, like the 200 simple moving average, if you're a trader, and it drops below, the smartest thing to do is to lock them in. You can always reload if it breaks back above. This pulled down here, it broke below the 100 simple moving average, it broke below the middle Bollinger Band, and then it also closed below the 50 simple moving average. Just major bear raid into the close. It needs to hold 9 cents. If it can't get above this or get back above the 50 simple moving average at 10, that's going to signal downside risk, and it needs to get back above the 100 simple moving average at 15 to get a bullish moving going again to the upside. Okay, take a look at CHMA. Keep an eye on this thinly traded ticker. It did close up 40% on Friday. It closed above all the moving averages on this chart. Okay, so yeah, it's a very ugly chart. It had this sideways action here, and then it had the dip. That happens a lot of times where they shake everyone out on the dip, and then you could see this very long sideways channel for a long time, and look how they shook everyone out. Dropped it down to 124 after 140 was major support, and then what do? They ran it. Everybody that got shook out here is super bummed if they exited with having it finally break out to higher levels. That's what happens in penny land. It's all about patience, or just waiting and stalking your prey and waiting for the right timing. On this stock, it's above all the moving averages, and so if you look over here in the left-hand corner, you could see the top moving average is the 300 simple moving average at 171, and so that's going to be the big level to break. If it can stay above that 300 and 400 simple moving averages above 171, that's going to signal more upside potential. If you see it drop below 170, that's going to signal more consolidation. It could work its way back into this channel. It's only going to be a good play if it stays above 170, 171. Okay, take a look at SNOA, another thinly traded ticker that was heating up on Friday. You can see how they really drove this thing down. There was a gap down back here in the second week of June between these two candles. They drove it all the way down. This was the signal that people were loading here. You have a signal here with the long lower wick that they were loading off a low of day. Keep in mind, this is a thinly traded stock. Why I put this in the video is because it did close above the middle Bollinger Band, currently at 228. If it can stay above 228, it's in play for a potential run up to the 50-day simple moving average at 270. 228 is also the sell zone. If it fails to stay above that level, it will be a signal to exit. Okay, it's only a good play if you can stay above that middle Bollinger Band. Okay, take a look at CORI, closed up 20%. This is another thinly traded, very thinly traded stock. Keep in mind, this is in the healthcare sector. The healthcare sector is hot right now, so there's a lot of beaten up healthcare penny stocks that have been driven down, like this stock. Look how the dotted purple line here is the middle Bollinger Band, and it had just kept failing to turn it into support, and the downtrend has just been continuing. Well, they've been running these stocks and getting, they've been, a lot of them have been more bullish than they've been in months, so keep an eye on the healthcare sector, especially for these small cap penny stocks. Right now, this needs to stay above that 50-day simple moving average of the green line at 822. If it dropped back below, that's going to signal downside risk. The close above the green line is super bullish. It hadn't closed above the 50-day simple moving average in months. The next key level to break is going to be that 100-day simple moving average at 910. If that breaks, you have the 200 and 300-day simple moving averages up here in the $10 resistance zone. Okay, if it fails to stay above 822, that's going to signal downside risk, and you could see that middle Bollinger Band retested. It's only a good play if it can stay above that 50-day simple moving average. Okay, take a look at PVG, closed up 19%. Very nice move on Friday. This is another one of those gap up and run. There was a gap between high of day on Thursday and low of day on Friday. It gapped up above all these moving averages, above the 200-day simple moving average at 840. That's the key level to hold. It will signal downside risk if it drops below. You can see how this was resistance back on the 25th of July. It failed to break that level and it pulled back. So the close above is signaling more upside potential. Now it needs to break the closing price here on July 9th, the 930 resistance zone. If it closes above 930 next week, that should signal more upside potential. And then you'll be looking at 980, the high of day from back here on the 9th of July, as the key level to break. If you look here at the PVG weekly chart, you can see here it has this ascending support line. It broke out and closed above the 50 and 100 week moving averages. So that was a really bullish close. If it can stay above that 100 week moving average at 912, it should run up to this 1050 zone. That's where the descending resistance line is lined up with, and that'll be the next big key level to break. If it gets above that 1050, then you have this $12 potentially on deck. That was where this was at multiple times throughout the years. You could see here in 2016, 2017, double top, almost hit that level at the start of 2018. It seems like this stock likes to run back up to $12, and that's where it stalls out. Okay, if you look at CRMD here, check it out, closed up 14%. It did have 5 red candles in a row that were followed by a white candle on Friday. So it did bounce on Friday off of EMA 13 right here at 53 cents. That's the orange line. So that's good that that level held. It signals that the uptrend is still solidly intact. The stock did come down and fill this gap on the second candle. So the gap is filled. God, it looks like there is a micro gap down here. That's never good, but there is a gap down to 30 cents. What needs to happen with this stock, first up, it formed bullish one white soldier reversal pattern. So it has a reversal pattern. We'll be looking for confirmation next week. And then it's going to need to break above this 400-day simple moving average at 66 cents. You can see that marked the top the last time. And so if it can bust above 66 cents, that should signal that it wants to head higher. We have 80 cents as the high there on July 30th. That would be the target if it can break above 66. Okay, take a look at AMPE here. Let's see, did I get this in the right spot? Let's see here. This is the AMPE daily chart. This is the one I want to show you first, and you can see here it's had a brutal week last week. This thing got demolished. Now you have RSI way down here at 24. It did close with the crossover on Fasto at 7. It's very oversold right now. It had 2 gap downs last week. It started out way up here at $3, big gap down. It hit right around $1 is the high, but then it closed down here around 60 cents, and then there was another gap down on Thursday. It did trade above the open on Thursday, and then on Friday it filled the first gap, or I guess you could call it the second gap, however you want to call it. It's the first gap on the way back up. This gap did fill. The key is going to be to get above the top of this first gap, which is right around 60 cents, about 59. If they can get above that 59.60 cent level, then what you're looking for is a run back in. The candles working their way back into the bands. Keep in mind, these three candles form below the lower Bollinger Band, which is the solid purple line. The candles always eventually work their way back into the bands. The moving averages are coming down fast. They will catch up with the candles. And so what you would want to see if you're a bull is to break above 60, get back into that lower Bollinger Band, and make a run up to EMA 4, currently at 104. And then you want to run up to the top of this, or the bottom of the next gap, which is right around $1. So if you can turn 60 cents into support, $1 would be the next target in the bottom of the second gap. If you look here at the AMPE weekly chart, you can see that really nasty drop. It was hitting the 400-week moving average here, or 300-week moving average here at $3. Okay, and it was failing to break that level, and so that was a red flag. 2 weeks ago, when it failed to break that level, was topping out, and then you can see the big drop down. It closed well below the lower Bollinger Band. The lower Bollinger Band is way up here at 115. It bounced off of support from back here in August of 2017. You can see the lower wick. People were loading this week. Look at the huge volume, largest volume week in many years. And so what you're looking for now are the candles to work their way back into the bands. The first major resistance, besides horizontal resistance from these candles, for as far as the moving averages go, you've got the 100-week moving average way up here at 144. Okay, if you look here at the AMPE, this is the monthly chart. Okay, so we're going deep here. I'm giving you the daily, the weekly, and now the monthly chart. And yeah, this is an old chart that we had been working on. And yeah, you could see here it came down and continued to. It's continuing inside this pattern. You can see this downtrending channel, and so it hits the top, which it did again, and then pulled back, and then you could see it's coming down. Came down and hit near the bottom of the channel and bounced. It's all about holding 50 cents. 50 cent is the big number. If it dropped below 50 cents for the month and closed below, that's going to signal more downside risk. The bottom of the channel now is way down here, so that could put it down in the 25-cent range or something if it kept going with this current pattern. Notice how it's getting wider as it's dropping lower, and so this is like a downward megaphone pattern. It's nice when these patterns are upwards if you're a bull, but downwards, that's painful. You can see this is a monthly chart. This is a multi-year chart, and so it keeps failing to make higher highs every year, and so what it needs to do now, I guess it made a higher high in 17 over 16, but it closed below the high close. I go by the closes. The high close in 2017 was below the high close in 2016, and so that looks like the process is repeating again here in 2018. What you're looking for now, if you're a bull, are the candles working back up into the bands, and you have the middle Bollinger Band way up here at 157. Okay, take a look at AKER here. Closed up 15%. This is another one of those bounce plays. We had this, on our chat on Thursday when it was bouncing, and it formed this bullish harem reversal pattern, following 5 red candles in a row. And then on Friday, it confirmed the pattern. The white candle confirmed this bullish reversal pattern. It did close above EMAs 4 and 8. So it needs to stay above this 25, 26 level. If it closed back below 25, it will below EMA 4. As you can see on this chart, holding and being long while it's below EMA 4 is deadly. You're just going to lose money. It has to be above that level if you're going to play the bounce. A drop below would be a sell signal, and then if a close below would be a sell signal. They shake around a lot intraday. What you're looking for now on EMA 13 is a close above EMA 13 at 28. That's going to be the big level. If you see it trading above 28, look for a run up to that middle Bollinger Band. It likes to run up to the middle Bollinger Band and top out. That has been the pattern since support broke back here on the 29th of May. Okay, on this candle. So ever since this, right before this candle, the candles were above the Bollinger Band. Ever since it dropped below, there hasn't been, it hasn't been able to hold that level. There was one close above the middle Bollinger Band right here on the 16th of July. It closed right at it a couple days later. But what you're looking for now is a run up to that level. If it hits that 31, that middle Bollinger Band resistance level, and it fails to break above, that's going to be the sell zone. Okay, let's look at XBIO. Closed up 5%. It only had 133,000 shares traded. I have it in this video because it looks like it's heating up. You have a PSAR bull flip. You have the green dots above the candles. They flip below here finally on Friday. And so that's a signal that this sideways action could possibly break and a new uptrend could possibly begin. Notice that there's a downtrending channel. You have descending resistance. Descending resistance with the red line and descending support. And so it's formed this downtrending channel. But within the channel, it has a descending triangle. You have horizontal support right here. Going across here, and you have descending resistance. And so what really needs to happen, this is a huge flex point right here. You can see the descending resistance line and the horizontal resistance line are coming together here. That's what they call the T-spot. If it breaks above that level, that's going to be a huge signal that it's ready to head higher. So if you see a XBIO trading at, we'll just make it easy, at 350 or above next week, and it closes above that level, that's going to be very bullish. What you want to see is a close above the 50-day simple moving average at 323. That's the green line here. You can see the candles are hitting that. And then above that middle Bollinger Band at 330. If it closes above both those levels, that should be our clue that it's back in play. What you also want to see is a volume spike. Look at the low volume. They were able to walk this thing down on nothing. And so as soon as they're ready to let this thing run, you're going to see a bullish volume spike. A volume spike similar to these types of spikes over here. You're looking for this type of move. Consolidation on light volume, followed by a volume spike and a push through resistance. That's what you're looking for next week. A volume spike, push through resistance equals showtime. Okay, let's look at ITUS here. Closed up 16%. This thing is heating up. It's another thinly traded ticker. It had this symmetrical triangle type of pattern here. You can see you've got descending resistance. All right, and then you have ascending support, and it formed what we call a symmetrical triangle. You can see the 2 points were coming together, and Friday's candle was wedged right in between the 2 points. And so we call this level the flex point. There's either going to be a break above resistance or below support. And what happened on Friday, it broke out above resistance. So this is a clear signal that it wants to head higher. Notice how there's no upper wick on Friday's candle. That's what we call a white closing Maru Bozu candle. All right, that's as bullish as it gets. The bulls are in control into the close. Usually when that happens, it spikes fasto up to 100, signaling temporarily overbought. And you do have RSI at 73. So you really want to keep an eye on RSI next week. It has to stay above 70. If it drops back below, that's going to signal downside risk. And what you could see is a drop back down to this 100-day simple moving average at 362. That is the big level to hold. As long as it stays above 362 and that 100-day simple moving average, it's going to signal more upside potential. Keep in mind, this candle did close well above that upper Bollinger Band, so the candles could work into the bands, bounce off the 100-day simple moving average, and still have a very nice uptrend going. Now, if it does stay above this 385 level or so, the close here, this top of 380, 382, whatever that is, then you're looking at this 410, and then 470 is the ultimate level right now. That was this closing price back here in April, and it was the high close in April. So what you're looking for an extreme bull move is a working its way back up to that 470 resistance zone. Finally, I'm going to leave you with BIOAQ. This used to be BIOA on the big boards. They filed for bankruptcy. They went over the counter. It was a big winner on Friday. It closed up 71%. This is one of the stocks that we cover in the chat. We do cover the over-the-counter stocks in the chat. A lot of people, a lot of small-cap penny stock traders, and so we try to stay on top of it. We usually just focus on them when they're in play, and that's usually when I will talk about them is when I see that there's some kind of bullish or development or bearish setup where it's getting ready to pull back. Trying to alert people. And so for this setup, it's finally broke above EMA 4 after trading below since this drop. It had this very nice uptrend going. I know people in the chat did really well in June trading this thing from down here at a penny all the way up to clear up to almost 10 cents. This was a 1,000% gainer type of stock. I mean, if you got it down here in the double O's, it was even more. And so now it's back above EMA 4 at 0.12. It needs to stay above that level. If it dropped back below EMA 4, it's going to be a risk to hold. It could end up back into double zero land, which would be very, very bad for the stock. It's got to stay above a penny, above EMA 4, and then you're looking for a break back above the bottom of the gap. There's a gap between low of day on this candle and high of day on the 30th, between the 29th and the 30th, and so that right below 2 cents is going to be a big level to break. It's got to get above EMA 8 at 0.17, and then above that 1.922 and 2 level. You know, if it trades above 2 cents, that's going to be really bullish. It's going to put it above the bottom of the gap, and then you could see it possibly run up to that EMA 13 at 0.25. Okay, so keep an eye on BIOAQ. All right, thanks everybody for viewing this video. Yeah, keep an eye on DDD. This was a big winner last week. It might take a breather if it fails to break that 20 to 22 resistance level.